Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Welcome back to the channel, Savvy Traders. Today, we're diving deep into a stock that's showing some fascinating characteristics on our hard-to-borrow screener, Inc., ticker symbol ZCMD. If you've ever wondered what it means when a stock becomes incredibly expensive for short sellers, and what that might imply for its price action, you're in the right place. We're going to break down ZCMD's unique situation, its high cost to borrow, and what it could mean for anyone watching this microcap healthcare play. Let's get straight to the facts about Inc., ZCMD. This company operates in the healthcare information services sector, specifically providing healthcare information, education, and training services to professionals in China under the MD brand. With a market cap of just $6.02 million, ZCMD is definitely in microcap territory. They run two segments, MD services and sales of patented drugs. Looking at recent price action, ZCMD has seen some significant downward pressure. It's done 2.91% today, a steeper 12.28% over the last 5 days, and a notable 55.36% over the last 30 days. Volume today stands at 7,078,800 shares, which is actually quite active compared to its 30-day average of 9,787,706 shares, putting its relative volume at 0.7x average. What's cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB, and why should you care? When someone wants to short a stock, they first need to borrow shares from a broker. This isn't free. Just like borrowing money, there's an interest rate, or fee, attached to borrowing shares. This is the cost to borrow. It's usually expressed as an annualized percentage. The higher this fee, the more expensive it is for short sellers to maintain their short position. And when this fee starts skyrocketing, it's a big signal that something unusual might be brewing in the market for that particular stock. These fees can absolutely exceed 100% annualized, sometimes even reaching into the thousands, when demand to short is extremely high and the supply of borrowable shares is extremely low. Why this stock is hard to borrow right now? This brings us directly to ZCMD. This stock has appeared on our hard-to-borrow screener for a very compelling reason. Its cost-to-borrow fee is an astounding 846.6% annualized. Think about that for a moment. Short sellers are paying over 800% per year just to hold a short position in ZCMD. This figure suggests an extreme scarcity of shares available to borrow, combined with high demand from short sellers. ZCMD's estimated float is quite small at just 1.1 million shares, which exacerbates the scarcity. We don't have current data on shares available to borrow, but with such a high CTB, it's safe to assume they are very limited. Our internal composite squeeze score for ZCMD currently sits at 47.5 out of 100, reflecting this elevated CTB and other factors. Squeeze mechanics explained. Now, let's connect this to the idea of a short squeeze. When a stock like ZCMD becomes hard to borrow, and the CTB rate surges, it means short sellers are getting squeezed on their fees. If the stock price begins to move upward, these short sellers face a double whammy: losses on their position and exorbitant borrowing fees. This pressure can force short sellers to buy back shares to close their positions. This buying activity, often done quickly to stem further losses, can create a surge in demand, pushing the price even higher, which then triggers more short sellers to cover, creating a rapid feedback loop known as a short squeeze. A small float, like ZCMD's 1.1 million shares, means any significant buying pressure can have an outsized impact on price. Dilution risk check. Before getting too excited about potential squeeze plays, we always need to check for dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This typically reduces the value of existing shares and can completely offset or even negate the short squeeze thesis, even if the cost to borrow is sky high, because new shares provide an easier way for short sellers to cover or for new short positions to be opened. For ZCMD, we've reviewed recent SEC filings and found no recent dilutive SEC filings -1/-3/424B in the last 90 days, which is a positive sign against immediate dilution concerns for this specific period. Recent reverse split watch. One crucial factor for ZCMD is its recent reverse stock split. ZCMD executed a 1-for-3 reverse stock split on June 29, 2026, which was just 48 days ago. A reverse split reduces the total number of outstanding shares and consequently shrinks the float, while proportionally increasing the share price. Historically, for many microcap stocks like ZCMD, reverse splits can reset the trading dynamics and sometimes lead to renewed volatility or even a price pop within about a month or so after the split. This isn't a guaranteed outcome, but it's a pattern we've observed in some names. Given that ZCMD's reverse split was relatively recent, this could be contributing to the current heightened interest and volatility. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. It's crucial to remember that a high cost to borrow, even ZCMD's astonishing 846.6%, does not guarantee a short squeeze. Sometimes, it simply means that short sellers have very strong conviction that the stock will decline further, and they are willing to pay significant fees to maintain their positions. For ZCMD, if you are watching this stock, keep an eye on volume surges, any significant positive price momentum that could start pressuring short sellers, and ideally, any data on decreasing shares available to borrow. John Cho Inc., ZCMD, presents a textbook example of a hard-to-borrow stock with its extremely high 846.6% cost to borrow and small estimated float of 1.1 million shares, compounded by a recent reverse split. While the current price action is trending down, these unique characteristics make it a compelling stock for educational purposes, highlighting the mechanics of short interest and potential squeeze dynamics. Remember, do your own due diligence. If you found this breakdown helpful, please hit that like button, subscribe for more unique stock insights, and let us know in the comments what other hard-to-borrow stocks you'd like us to analyze next.